Well, I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout this show. Well, in a week of very dull trading, the stock market continued its upsurge as investors and traders grabbed onto positive news about the trade war coming out of China. The week saw stocks jump right out of the gate as the Trump administration last weekend was touting the trade deal. And the gains for the week really all came on Monday, and we saw the market pop a couple times, but really stick each day in very, very narrow trading ranges. Throughout the week, China had said several times that the U.S. and China had agreed on a 4-stage rollback of tariffs. However, Trump hardliners are against this, and there's been pushback by Navarro, and that weakened stocks a little bit on Friday, but they can't stay down, and they actually did come back. China's trying to put a positive spin on this trade deal. And to me, it seems like pure fantasy. They want the people to believe that, that they are doing something about what's been slowing down their economy. And they want Trump to believe that they're actually going to make some kind of a big deal with him. But I don't think that's the case at all. I think it's all really just fantasy. And we saw a modest dip come on Wednesday as the plan for the phase 1 signing of this trade deal. That got delayed based on the date and the location, and all that really seems in doubt. It was November, and then they changed it to December. And then Xi came out and said, well, we're not going to do this in the U.S. So not only do they really not have any agreement, but they also don't have any timetable for this. So the stock market, which has responded in a positive way, I believe is more doing it because of the huge amount of liquidity that has been poured into the market with almost nothing to do with the trade war and comments. The market just was ready to go up, and we had talked a lot about that. So don't be surprised if this phase 1 deal takes longer to put together, and that along the way it could make investors nervous. And I'm betting that phase 2 does not even happen in 2020. How do you like that? Because I don't think they want Trump to be have any kind of a real win in here, and they probably want to be along rid of him. So I'm going to say phase 2, well, just forget about it. The biggest focus really should be on the treasury markets, if you ask me. And this is perfect, in-your-face paradox. As Fed is cutting rates, pouring tons of money in, and interest rates are exploding. Yes, as they are lowering their Fed fund rate, the longer rates, 10s and 20s and 30s, are exploding to the upside. The bond market had a nightmarish week. It really collapsed one day with the 30 years down over 2 full points. This was a bad week for the interest rate market. And things are, with the bonds going down a lot, it's basically being ignored by stocks. But it's not really being ignored by gold, because gold doesn't like it when interest rates go up, and especially when the stock market goes up. So it wasn't a great week for gold. But this is historically in line. Rates go up when the economy is stronger, and that tends to be bring a focus more on the growth prospects for companies, and the market tends to, at least in the early stages of interest rates moving up, the stock market doesn't do all that badly historically. But the activist Fed that we've had in the past 2 decades puts us in a new paradigm, however. And we saw last December what happens when rates go up. As a matter of fact, we saw the stock market plunge a very quick 20%. So it was a double whammy with the Fed draining and interest rates going up as they were doing QT. But now interest rates going up again, and at some point down the road, if this continues, this is going to be a lot of trouble. Let's take a little quick look at a chart here on the TNX. This is the 10-year interest rates that we're looking at, the TNX 10-year yields. And you could see in here as we look at this that, I mean, there was a pretty good downtrend going on in yields, and they plunged in a moment of panic all the way down to 1.43% that you could see right there. This is our cycle analysis, and clearly you could see that downtrend as each of these downward cycles made lower and lower yields. However, things are changing. And now you could see an uptrend in yields right now. This does affect some stocks negatively. While the more positive yield curve is good for banks, it's terrible for the home builders who had really a bad week. Here's your base that got built in yields right over here. And I talked about this in Future Speak also, saying that it really looked to me like the bond market was in a lot of trouble. This is a very bullish occurrence, a positive cycle, then this cycle that hits the minor supports and bottoms on the early side and then takes off again with yields getting above this level of the last cycle. This is a cycle measured from low to low. And what that says to me is that yields are going up. And when I see what's going on in the bond market, that is a lot of trouble. It really says to me that you can expect that we're going to see higher rates, and breakdown in the bonds says to us that the futures, when the futures pop, they really should be sold. So that's a look at the 10-year chart. For a while, markets probably be okay with that, moving up with rising rates. Like I said, this does help the banks. They can make more money when they borrow for cheaper. They get their money cheaper from the Fed, and then they can loan it out for higher prices, higher interest rates. So that steepening yield curve is good. And that's been, the banks going up, they've been really leading the market to the upside. But signs are that the Fed is losing control. So in other words, Fed pumping in money, pumping money into the repo market, building their balance sheet at an extraordinarily fast rate, and taking it up from 3.5 trillion up over 4 trillion right now. So they're pouring money in. They want to keep things stimulated, and interest rates are going up. So there really looks to me like they're losing control of this market, and they're in a lose-lose situation. If they cut rates anymore, the markets are going to see that as inflationary. They're going to see it as stimulative, and the bond market is going to go down. If they decide to tighten, well, the bond market might do something a little better, but the stock market's going to go down. So, and of course, Donald Trump does not want the stock market to go down because he feasts on that news all the time as the stock market goes up. But we think this lose-lose that they're in is going to really affect the markets, and that's the story for our bear market we believe is coming starting in early 2020. In the meantime, we have looked for a positive last quarter to this market, and we have been getting it. So that is in line with our analysis, and we're going to look for higher stock prices into January, early February, before we think a very significant bear market hits. That election year coming up, it's going to be ugly, and with Democrats going to be leading in the polls, the market's going to be afraid. And I think it's over these next couple of months, it's really important for you to look at longer-term allocations to your longer-term holdings. Stock market for the week makes fractional gains. Bond market 30-year loses 4.75 points, 10 years up 18 basis points, and the yield curve steepens some more. Gold down $55. What do you think about that? We were worried about a capitulation in this stage. We think gold is going to do much better going forward, but right now they're puking it out, and we'll be looking for a bottom to form pretty soon. The dollar being stronger really is, and the bonds being quite weak, is not a good situation for the gold and silver market. Silver plunges 7% on the week, about $1.30. Big decline there as traders get absolutely caught on the long side on that one. The dollar, 5 straight up days, up about 1.3%, and money flows to where it can earn the most. And when you get long-term rates going up, the dollar goes up. So, and oil, a very choppy week, and about unchanged on the week. Make sure that you follow us on Twitter. That's at askSlim. We post stuff up on there every single day. And become a YouTube subscriber to our channel. And please do, if you're watching this on YouTube, give us a thumbs up. So have a little bit of a special announcement in here as we talk about what our new products are that are coming out. I mean, our services are just amazing, and the depth of the products that we bring out is incredible. We have stuff all the way from very short-term traders to now developing products for investors and longer-term holders. Here at askSlim, our objective is to deliver professional-grade technical analysis, trader education, and trade planning tools. And we are excited to announce, very excited to announce, 2 new products that are coming out in the next week. That is our trading ideas, which is kind of an upgrade from what we do now from our trade setups. You're going to find that extremely valuable, and we're going to do them much more often. And the askSlim Slimulator Momentum Tracker. This is for longer-term holders and investors, and it is going to blow you away. This is a sample of our trade ideas, which will give you some really highlighted information on when we do our analysis and we see a specific a range, an entry range, we're going to give it to you. We're going to let you know what our bias is. So you can see right in here, this is an XLE in this example, a long bias, and the term for this is 3 to 8 weeks for this setup. So that's kind of a little longer term swing trade, and it's a trend momentum continuation. So in other words, that tells us that it's already been in an uptrend and looking like it's getting ready to give another move to the upside. We give you the favorable range to entry, so you're going to use that range to know that, well, you can go pick what fits your own entry style and your trading style and put something on. This is our target zone that we're looking at, and this is where we're going to reevaluate it, that maybe the trade is going wrong. So we want to really look at that. And we give you some information in here about the individual trade. Just phenomenal when you look at that, the information that you're going to get. That is the trading ideas. And then there is, we're going to, by the way, take that out of our 300 plus stocks that we look at, plus stocks that through our member voting that you have interest also. And then the next one is our Slimulator Momentum Tracker. This gives you, this is a sample of what that looks like. And this is just for investors, longer term swing traders, long holders. It's programmed with our three time frames with momentum indicators. Our algorithm is going to generate directional bias and market outlook. So you can see in here, in this example, Apple, very bullish, strong positive conditions suggest only minor declines and higher prices. And you can see long-term, intermediate term, and short-term momentum indicators are all positive. This is a very, very nice setup here. And, you know, Apple's been going up. So you can see what this looks like. You'll be able to create your own watch lists and it's just going to be so valuable for our investor or longer-term holder members. Just a great pair of new things coming up. Thanks to our financial data partner, Intrinio, you'll be able to search proprietary askSlim momentum readings on more than 1,000 symbols every single day. This is live all of the time, and we have a lot more to tell you about this coming up. Our beta testing period is coming soon. You're going to want to be an askSlim member to get the beta testing done. You can just become a free member and be part of that. That's going to start in the next week, so you really want to do sign up. Go to askSlim.com and become a free member if you're not a member, and you'll be able to participate in the special beta testing period, especially if you're an investor, long-term holder. You're going to want to know what your portfolio looks like as far as these conditions go, and that you can see is just going to be fantastic. So that's a look at the two products. Please do go to askSlim.com, and you will be able to see what I'm talking about as far as this beta testing period. Sorry for that chart. I really meant to go to our worst 5 stocks of the week. So we're going to look at the worst 5 stocks of the week. We're going to look at the best 5 stocks of the week, and just kind of flipping them around this week. So we'll start with the worst first. So we're going to switch over to a weekly chart of EXPE. That is right here, and we're of course looking at cycle analysis, and you can see EXPE had a horrible week. Look at this week on the downside. Clearly you could see the cycle analysis in here. These are the rhythms of the market, the heartbeat of the market, and this looks like it has still another few weeks to fall. Expedia down 27%, a huge earnings miss. Online Travel Group really gets killed, and part of this is on about Google favoring their Hotel Finder platform, and nobody really knows how much competition that's going to be, but all of these online stocks got absolutely hammered on the downside for that reason. Expedia is not viable, if you ask me. I just think that you might get a bounce in here and starting in a month or so. But where's it going? Going nowhere, and the competition for them is going to get a lot worse. TripAdvisor, you can see that right in here. It's the same type of a thing. I just want you to see the magnificence of the use of cycle patterns and how they create the important big patterns. Here's your inverted head and shoulders. You will note here that the left shoulder and the right side of the head was formed by this cycle. That's the left shoulder and the head. The completion of the head and the right shoulder was formed by this cycle. Cycles make these patterns happen. Once it broke out above this level, the projection is the same distance from the bottom of the head to the neckline. So from the breakout of the neckline to this level, bullseye. It exploded up there and then started to dive. As well, investors were worried about competition. Look at these cycles and minor cycles that are stair-stepping on the downside. You can see this important low here and this crummy rally, and then the big break. Trip down 22% on the week. Same story. Analysts downgrading this stock. Earnings missed, and Google competition all over it. And you can see in here we're projecting a low in the next week or so and a crummy rally and then another big break to the downside. So TripAdvisor down 22% on the week. Expedia down 27% on the week. Booking's down about 8% on the week. It's also risky, and we think Booking has a decline potential coming into year end. That is a look at the online stocks, online travel stocks. Sorry about that. And now we're going to look at a stock that is a stock that I have been positive on. Now, when I did a video about a few weeks ago on 25 stocks that I thought would participate in the rally on the upside over the next couple of months, Mylan was one of them. And I made a point in there that, well, it's building a base, that it might not have quite made a low, I wasn't sure, and it got sold off very hard. Now, when you get these hard sell-offs at the ends of cycles, well, number one, that's common, and number two, that's often a capitulation. This, to me, still looks like a base forming, and I think that Mylan, which lost 14% on the week, is likely to have a pretty good rebound in here. Their revenues missed, and analysts are downgrading this stock. And I actually think that this is long side holders dumping now in a big way. And I think the stock, which is now trading at 1734, is pretty likely to get back up to that 20 range pretty soon. So Mylan down 14% on the week, and I like it. Now, the oil stocks have been trying to make bottoms. Chevron doing a decent job, Exxon trying, and Oxy a horrible stock. Now, this stock down 9% on the week. It had a bigger loss than expected, and this is one of the worst patterns that there is. I mean, this stock is kind of bleeding money right now on this bigger loss, and we see a bottom forming in here. I would call it too late to sell right now. And then if we get some kind of a bounce in here, then there may be a better selling opportunity. But this stock, one of the worst of all the oil stocks, down 9% on the week. And the last stock in the worst of the week we're going to look at is KBH, and that is KB Home. And you can see here, look at that double star evening star. It flew through the extension target zone right there. That comes off of this cycle, and looking at the extension of 78.2 to 100% of this move right over here. It exploded through it, but then gave this sell signal. What's this all about? This is all about interest rates, and the home builders love it when interest rates are going down, and they hate it when interest rates are going up. Investors hate it for this group. This looks like it's going to decline to $30 or even down to about 28 and a fraction between now and the beginning of January. This is not a group I want to own. Big sell signal, and when I talk about interest rates going up, that is bad for this group. So this group in the home builders, I don't like them at all. 8% down on the week for KB Home. I think that the whole group is a sell. Beazer down 7%, Lennar down 5%, Pulte Home, D.R. Horton down about 4% on the week. And I think given opportunities, if they tick up on days when the bond market rallies and yields seem like they're going down, well, I think they are sells. That is the worst for the week as I switched around a little bit, and now we're going to look at the wrong direction in here. We're going to look at the 5 best stocks for the week, and the first one we're going to look at in here is Baidu, B-I-D-U, as we switch off of that KBH chart. Look at this. Now, this to me is a bottom that's formed. You can see, of course, with all of the trade war situation, this is a Chinese e-com stock, and this stock had this huge plunge, 284, all the way down under 100 over here, and it fell for about a year and a half. I mean, nonstop. This really looks like a base to me. As a matter of fact, this is a little inverted head and shoulders right in here. And now it breaks out, and there are some resistance zones that you can see in here. However, this stock looks to me like it's going to head up to 140 to 150, and it's now trading at about 124. This is the first or second week up of this rally phase. That's really early, and the likelihood of peaking is very small, and especially after this type of a formation of this inverted head and shoulders. I mean, I really could see the stock making a lot of upside ground in here between now and that peak that we're looking at out at the end of January, beginning of February. So, like this stock a lot in Baidu, it's their revenues beat. Analysts are all over it, upgrading it right now this week, and I'm going to say yes. I really do like it, and the patterns are great. The next one we're going to look at is CPRI, which is Capri. This is cores. And this pattern in here is a little oddball because usually the low that's in the middle gets tested a little bit deeper than this one did. There's some anxious buying going on in here. Now, their earnings were pretty good miss, and their expenses are going up. So what is going on that this stock is ticking up? The only thing I can figure is they actually expected worse, and the shorts got a little trapped in here, and they're bidding it up. You can see this cycle peak resistance coming right across over here, at about 38. I actually don't think the stock could do a lot better than that, maybe a little bit more. But then we think it's going to be headed down again. So in this case, a big gainer of 11%, we do not like it. And we just think it was kind of a short covering action that's in here. Now, Regeneron is the next one we're going to look at. Really expensive stock in the biotech category. This stock just absolutely flew out of here. You can see the patterns in here. It's pretty volatile. I mean, this low over here is around 280. This high over here is around 440. This low over here is around 265. There's some major resistance right in this level over here, but 355 to about 375 is our upside target in here in this positive part of this cycle action. So we look at phasing, we look at rising phases, peaking phases, declining phases, bottoming phases, and in this case, we're still in the rising phase, and I actually don't think the peaking phase is going to come until the end of the year, beginning of next year. Very good sales report on their Dupixent. They're expecting more than $10 billion in sales in that drug. Analyst upgrading the stock. Citigroup says buy it all the way up to 420 is their target. We're going to look at that 355 to 375 as a reasonable target. I like Biogen better, BIIB. I think it's a better opportunity for a bigger move in there, and their Alzheimer drug is really going to get highlighted, showcased in coming weeks, and I think you're going to see BIIB do better. But our Regeneron looking okay to me. The next one, HPQ. Who could imagine that a stock like this has colored phasing in it, by the way. That's why you're seeing all those colored blocks. So this stock has been negative. You could see anytime you see green, yellow, red, green, yellow, red, green, yellow, red, that's a bad stock. I mean, it really is negative. You had it again going on right over here, but this bottom I would never have called, never, because it's due to bottom over here at the right in late December. And just like every one of these patterns, you can see the beautiful synchronicity. Important low here on this cycle bottom, important low here on the cycle bottom, important low here on the cycle bottom. This makes no sense, simply because the fallen giant of Xerox is chasing this Hewlett Packard. Now, this is a pretty big gulp to be able to buy it out. It's is it rumor or is it fact? It sure seems like they're trying. And, of course, thank you, Fed, for all the cheap money so that even a company like Xerox could be buying this a company like that. Xerox was one of the nifty 50 that when I started trading in 1974 was a high flyer with Polaroid, of course. So I lived through those days and saw Xerox got absolutely killed. And the fact that Xerox would buy out Hewlett Packard, well, that blows my mind. Anyway, this is a rally and this huge move that I would never catch. If it turns out that somehow Xerox can get that money to buy this stock, it's probably going to be more than $22 when that happens. So you feel like taking a shot? I don't know. I'm not going to. But there is a possibility here as this 8% gain on the week, which was much more, they could come after it again on the upside. So do you want to sell it here? I'm not going to sell it, but I don't think I'll get hooked by that. And the last one is Qualcomm. Qualcomm was on my list of stocks that I thought would do very well for this period. Now I'm going to move this so you can see our fib extension target zone here. Anytime you see our blue arrows here, it pointing to a higher target zone. And beautiful cyclic action that we're seeing in here. We call this a swamping in a right-hand translation, when this declining phase right over here can't give you any selling. And what that tells you is that there's a lot of buying in there. And that's what we saw, some real buying coming in, and this explosion to the upside here, 7% on the week. Earnings beat, analysts love it, upgrading the stock. Our target on the stock at worst is 100 right over there, and it could do better, maybe to the top of that fib extension zone up here around 108. So that's what we're looking for, further upside prices in Qualcomm. We thought it was positive. It's moving up, and we're happy about that. So that is a look at that. All right, so that's the 5 worst stocks, the 5 best stocks for the week, and now we're going to take a look at our short-term view for the 5 major markets for the coming week. So we're going to switch over to the daily chart here. We'll leave Qualcomm and we'll go to light crude. I always want to be accountable for what I said in the last week. And this was not a great week as far as the analysis goes. What I look at are the cycle patterns. I want to, look at the support resistances and whether or not I think they're going to be up or down for the week. So that's 3 or 4 pieces of criteria that I look at to judge how well I did. Not a great week. 40% accuracy is what I'd give myself in here, and we're going to do better next week, of course. For the light crude market, we thought it would come down and then go up. It never really came down. Well, it never really went up either. And we thought it would be an up week. It is an up week right over here by a slight amount. So we get pretty good credit for this one. It sold off, then came back. You can see that. And we think it's bottoming on this cycle right here. It was timed pretty well, and now we're going to project the upside in here, 58 to 58.60. Well, right now it's 57.12, so we're going to look for a potential up to that area of 57.60. Those highs right over there around 58. And that is our target for the week. We're going to call it an up week. Note that momentum is positive. We always want to pay attention to that right in here. When momentum is positive, the projection oscillator gets oversold. Odds are high you're going to get another upside move, just like you did right there. So very clear cycle patterns right there, and we're going to get pretty good credit for that one. We get no credit for the gold market this week. We thought the gold market was bottoming and ready to go up. We didn't think it had this capitulation coming, though we talked about the possibility of it. This is shifting out a little bit now. The gold and silver low timings are starting to meld in here and get close together. I like to see that because the cycle synchronicity, as we call that, gives us a better sense of timing. So lows are due out over here in about a week or so, a little bit more. We expect that the gold market is going to test that 1454 support from the weekly right over there, and then get ready to turn to the upside. So, excuse me. For the gold market, we're going to look for that little test on the downside. We're going to say a small week. In other words, it comes down right in here and then tries to come up again. Compared to this big downside week, we think it's going to just really tighten up in there. When you get into these cycle bottom areas, you get into periods after a big down move of what we call a lower period of velocity. When the velocity is big and you get to support, it tends to get lower and then start to curl up. So we're going to look for a smaller week in here for the gold market, kind of digesting and maybe making slightly lower prices. Momentum, negative, but it's been choppy. So when you see the slim ribbon kind of laying on itself right over here and these arrows going up and down, you don't have any momentum in there. So even with this break in here and the momentum turning negative, it's not really significant. In other words, it's not really decisive as far as that goes. The next thing we're going to look at is the dollar. That's $ DXY. And you can see it here that this is super strong. Now, the dollar took off right in here. And we thought that the dollar would come down to about 96.70. In other words, one more trip down to this support right in the bottom or below that, and then move up after that. Well, it didn't have any downtick at all as the bond market collapsed and interest rates went up and attracted all this buying coming in here and now getting up to that resistance area. So we're going to look for a minor pullback in here in the dollar and then moving up again. That would give it a small week similar to what we're looking for in the gold market. But actually pretty much opposite, which makes sense. So a small little movement in here we think as the dollar gives up a little ground and then tries to come back after a minor dip. Momentum has been negative. You can see that right in here, and now it's turned neutral, so it's improved. Note the sell signal right over here. That's with negative momentum and the projection oscillator getting overbought and turning down. And it brought that 3 big days on the downside. That was perfect. But now momentum is neutral. So we don't get any signal in there at all. We just think it's going to stall in this area. So 30-year bonds, we're looking at that next, and this is a bad pattern. Note our note here to our level 4 subscribers who get our charts. Level 3 subscribers will see this on the Slimulator. And we said this is a very early and very negative when we saw it breaking down in here. And then you had this big down day over here. So what do we have? I mean, this looks like a big breakdown extremely early, and what that gives us is a projection of declining bond prices for weeks and weeks to come. We've projected right in here that if it got a rebound, it would be a sell if that happened. So we're looking for that. And that would be opposite of what I showed you in the 10-year yields. In other words, we're looking for a rebound in here or a little dip in yields. But then we think that's a sell zone right over there. And that if we got the bond market up into this area of 58 to 58.24, that traders could be aggressively short, as it's a high probability it'll be moving to the downside. Note the negative momentum right in here, and each time the projection oscillator gets overbought and turns down, it gets whacked and whacked, and we think that's going to keep happening. Negative momentum, everything's saying bonds are going lower. That means yields going higher, and you got to wonder how much the stock market could take of it. Remember, we think it'll maybe shake it up a little bit, but we don't think the stock market's overall going to peak for a couple of months. So that's a typical, like I said, period of investor focus on growth rather than yield, and that can last for a while. So that's a look at the 30-year bonds. We're going to say bounce and fail is what we're looking at in there. We don't get much in there as far as credit for last week, because we thought that it would dip and then move up, and it dipped and then did not move up, and it had that breakdown. So that is a look at the bond market. Maybe a pop, but it's a sell. And the last thing we're going to look at is the stock market. So the stock market, we were talking about that it was likely going to have an up week. Momentum was strong. It was translating with a very positive bullish cycle that had almost no downticks right in here. It made sense that this was going to keep trying to go up. We thought 30.90 was the target. It got to 30.97. Now 30.90 is the beginning of a resistance fib extension zone that we, if you watch Future Speak, you'll see that on our weekly charts. You can also see that on our Slimulator and level 4 charts. So all of that is important information as to those levels. Now we think we're going to, that 3090 area or 3100 in there is going to end up to be kind of a resistance area, and we're going to get into some consolidation here. So this little dip that we're looking at is this dip here on this short 9-10 week cycle that probably gets down into this area here, 30.68 to 30.60. Test this as a buy zone. We don't think it's going to be able to give up much ground, then try to get up to that levels again. And then out over here is a little more risk that comes in November into December. We talked about a little more correction out into December. And then moving up again, basically into January. So this is we think will be a sideways corrective period. We're going to look for a small down week, getting into that zone under 30.68. And that's also coming into that midpoint of the slim ribbon coming up there, and then moving up again. Momentum just super strong. You could see where it turned positive here, and then the ribbon really started to open up, and that is very strong occurrence. As a matter of fact, the projection oscillator has not quite been able to get oversold and give clean buy signals, and this is a sign of strength when that happens. So lots of reasons to believe that declines will not be very significant and that the next move in the market of any significance may be coming sometime in the period of December, where we get a dip and then moving up probably strongly again as we move out into January. So that's kind of a little longer view. We'll call this week a small down week as we get a little bit of a correction here, but we think that would be a buying opportunity in that buy zone. That's it. I hope that you found all of this information extremely valuable. I'd love to hear from you. And please do send me any emails if you have any questions. If you want to get any of our trials, go to write to Matt at askSlim.com, M-A-T-T, and he'll send you our trial memberships and look for the beta tests coming up of our new products. That's it. I hope you loved it. I want you to be so careful. It is so crazy out there. And we're always wishing you great trading.
Well, I'm going to the city and I'm gonna do a step.